Panel, Tom Lydon is editor of ETF Trends, and Mark Demas, he is portfolio manager at Fifth Third Asset Management. Gentlemen, both welcome. Mark, listen, here's the reality. 50% gain on the S&P since our low back on March 6th of 666. 50% in 5 months for the broader market. Come on. Is that sustainable? That's got to spook a lot of people with the rapidity of the increase.
Yeah, it's been a very big move, and I would say that at this point in time, I think after 2 quarters of earnings, clearly beating expectations, investors really applauded companies that have really cut costs. Companies have very lean cost structures now. That's very clear. I do think though at the end of the day, earnings are going to have to drive the stock prices. In order for earnings estimates to keep moving up from here, you're going to have to see revenue growth. And we've seen a little bit of evidence that that could be coming in, but clearly not enough to really get estimates moving up. And if you look at that 2010 estimate number for the S&P, at this point in time, it really looks too high.
Yeah. Tom, let me bring you in here. You're a categorical bull, at least for the moment. You're feeling very positive about all of this. I think what Mark just brought out was very true. I've been talking to traders all weekend, and they're telling me this thing's got to go down. It's got to go down. But Wall Street climbs the wall of worry. We know that old adage. So what do you think pushes this market forward, if not the revenues that Mark has just very cogently said we actually need to see now?
Well, you're right, Liz. I mean, we're all looking for a reason. And those that have money on the sidelines are wondering, geez, am I going to miss it? When the major market indicators went above their trend lines, their 200-day averages back in May of this year, it was a clear signal for the first time in a couple of years that the wind has shifted. And now, if you're on the sidelines or if you've got a majority of your money on the sidelines, you can't wait for a correction. The thing you might use is the 200-day average to protect yourself if things do correct. But if we look for the fundamental reasons why this thing is going to continue, we may never see them, and the market still may move to the upside. So the trend's in place. There's $4 trillion on the sidelines, and if that starts creeping in, we're going to see this thing move higher.
But Tom, people say, am I going to miss it? They've already missed 50% if they have not been in the market.
Right, but if you look at the last time we saw something like this, in 2003, after the 2000 to 2002 decline, that year the market was up 38, 39%. Right. And it almost went straight up. So if you waited for a major correction, you just didn't see it.
Let's get some ideas on what to do no matter what the outlook is. Mark, give us your best ideas right now for tweaking the portfolio.
Yeah, sure. I think, right now you want to be looking for the winners for the next cycle. Those companies that are in great position to really, allow earnings to explode. And I think some of the areas that we're looking at, we think you want to be positioned in energy. We think you want to be positioned in materials. So the whole kind of go global theme, we think, is going to reassert itself. You can see it in commodity inflation, the weaker dollar, and so forth.
Southwestern. Let's get some names here.
Yeah, sure. So in energy, we think you want to buy Southwestern Energy, great production growth story. Also Anadarko as well, a very full pipeline of exploration potential. That's in energy. I think in technology, you want to play the smartphone theme through the end of the year. That's the big volume driver in tech right now. Companies that benefit from that. Qualcomm, and then RIM, who will continue to gain share through the end of the year. So those are my 4 picks.
You're kind of naming value and growth stocks. Tom, listen, you got your finger on the pulse of what people are doing out there. Are you noticing any trends among different types of stocks? Are people back in the financials? Are they going for tech, going for value? What are they doing?
Well, they are going for tech, but a couple areas to really concentrate on now. There are a lot of people that have been suffering from lower yields. Junk bonds are no longer as distressed as they were. And here, corporations have raised $900 billion so far this year, where last year it was only $500 billion at this time.
Got it.
So there's a lot of availability in high-yield ETFs, and iShares ETF is fantastic. You've also got the Home Builder ETF up there as well. Yep. And also biotechnology has been on a tear. Tom,
let me jump in. We've got 10 seconds, but I have to ask you this because a lot of my Twitter followers were asking, have you heard about anything about the banishment of leveraged ETFs? Are you hearing anything about that?
A lot, but here's the bottom line, Liz. The inverse and leverage ETFs do exactly what they're supposed to do on a daily basis. If you know how to use them, they're absolutely safe. The problem is there were some people and some managers who didn't understand that, so they've gotten a lot of attention.
Sure.
But for those that are banning them, it's like saying you shouldn't be riding a motorcycle because you're going to hurt yourself.
Yeah.
The bottom line is they're great products.
Yeah, exactly. All right, good to see you both. Tom Lydon, Mark Demos, thank you very, very much. Great to have you both.
Thank you.
Thank you.